Hi guys and welcome to my video. In this video I will explain what's a mutual fund and also provide a real example of a very popular mutual fund here in Canada, the TDUS Blue Chip Equity Fund. Let's go. What's a mutual fund? Think of it as a professional managing a pool of money. And when you're buying a unit, for mutual funds we always say unit. So when you're holding a unit, you are entrusting him to follow the fund's objective and achieve hopefully returns for you. Most of the time, the name of the fund will hint to its objective. For example, it would say a fixed income fund, meaning it's investing in investments vehicles that produced a fixed income. For example, a bond and uh, and such treasury bills. And also the second example is dividend fund. So it means that it's investing in the purpose of collecting dividends. So it's mainly stocks that pay dividends. You have also balanced, that we hear that a lot, or growth. Balanced would be in between. So it's buying stocks and also buying bonds at a rate of 50%. The purpose is obviously to reduce risk for you. So from the name, you can already figure out what kind of fund you're buying. Let's have a look at a real example here. The TDUS Blue Chip Equity Fund. So from the title, I know it's for equities, so it's investing in stocks. It tells me already it's a US, so it's mainly companies that are listed on the US stock in the US stock exchange. And blue chip, it would mean that it's a large company and it's usually a leader in the market where it operates, and also it's a company that's established, so it's been there for 10 years or more. The fundamental, if we look at the objective that the manager has stated for himself, the fundamental investment objective is to achieve long-term capital growth by investing primarily in common stocks of large and medium-sized blue chip companies. Also, blue chip companies are companies that pay always dividends, and they are basically achievers in their sector, and they never missed a dividend, for example. And the manager is promising you here that he's going to select from all the list of blue chip companies that exist in the US market, he's going to select the ones that produce above average growth. Since the fund is investing in blue chip, so definitely these companies, since they are large and they are leader in their market, so they are paying dividends. So they will be a component of income, not just growth for the fund. It will be also some income coming towards you. When you want to buy a mutual fund, the first thing you have to look at, a lot of videos talk about the management expense ratio. That's not really the first thing you have to look at. You have to look at the risk level. Am I comfortable with the risk level? That's your first question that you have to ask yourself. And also, since you're giving money to someone and you're buying a unit and he's managing this pool of funds, so you have to know who's managing it. What's his reputation? How long he's been there? His track record? In terms of reputation, you can just type on Google. They will lead you to videos of him talking in BNN or Bloomberg. How long he's been there, that's available in their website, or also his track record. You could look at the performance of the fund. How long he's been there is very crucial because the managers are holding a very tough a job. So they have to really provide returns and show that they know what they're doing. So the longer he's been there, the more comfortable in his position he is, and the more and less likely he's going to take risk to prove anything. He's been there for so long, he doesn't need to prove himself. He's going to go at his own pace to achieve the return without taking extra risk. For example, for the TDUS Blue Chip Equity Fund, the management, as you can see, is Larry Puglia, and he's been there since 1996. That's really a person who's been managing this fund for so long. TD has entrusted him. They're happy with his work. Investors are also happy with his job. That's why he kept his position for so long. In their website, they're saying that the risk for this particular fund is medium. Why they are saying is medium? Because you're investing in stocks and stocks go up and down. However, since he's limiting himself to blue chip, only large corporation, I mean, the chance that you see Walmart go bankrupt, Walmart is a perfect example of a blue chip. So if you see Walmart go bankrupt, the chances of that happening is really low. Blue chip companies are really large, they are dominant, and they are leader in their sector. So the chances that their stock loses 20 or 30% of their value in one day is almost nil. The one source of information that I would recommend that you look at when you want to look at the risk, don't go to the website of the mutual fund because they're just choosing general rule to tell you it's a medium risk. What I would suggest is using Morningstar risk measure. Morningstar is a company that's well known, has been there for so long, and this company does the has ton of analysts, and they look at mutual funds. They look at several companies, industries, sectors, and they're doing the analysis already for all the investors. And they are very reputable and they are well known. And usually, when you have an account with either a brokerage firm, you will have access to the information from Morningstar because, as I said, they are the reference when it comes to financial information. So, for instance, Morningstar, what they are saying about the TDUS Blue Chip Equity Fund, I want you to look at the risk versus the category. They are telling you this guy, this manager, is average. So he's doing basically, he's not taking a lot of risk for the category of the fund he is. So basically, in comparison to the other managers, he's doing, he is taking on the same level of risk. Then you have the second one, return vs category. So you're looking at this manager. I just told you he's been managing his portfolio, taking on the same risk as everyone else in his category. But if you look at the return, he's exceeding the return of the category he's in. So basically, he must be a very smart manager since he's able to bring more return versus the risk that he's taking. You have also to look at the holdings. What kind of companies he's investing in. So you have, in this case, Facebook, Microsoft, Alphabet, which is Google, and Alibaba Group. So you could see that these all are reputable names, and he has chosen technology companies for obvious reasons. I mean, they are looking at companies that produce above average return. And if you look at the past 10 years, companies that are in technology have been outperforming everyone else. Why do you have to look at the top holdings? Because you want to know, like in your portfolio, you have to be diversified. So you don't, like if you buy 3 or 4 mutual funds, you don't want them, all of them, to be in technology, right? So you want to keep your portfolio diversified. That's why you have to look at what the holdings of the fund. Also, they provide you with the sectors. So we see here that in technology his weight is 30%, then communication services, then consumer cycle. He's trying to diversify the portfolio, but it's still heavily invested towards technology and communication services, which is not bad as we know the current market trends. If you then you look at the performance. The performance, if you could see, there is the YTD, which is year to date. Then you have 1 month, 1 year, 3 year, 5 year, 10 year. This information is available because he's been around for so long and the fund has been around for so long. Avoid investing in a fund that has less than 3 years life. It's never, you will never get an idea about the performance of the manager if he's been managing for only 1 or 2 years. We know this guy has been here since 1996, and so we have available a lot of information to be able to assess his job. So if you look at the return, you have that the fund had year to date 29%. Then you have for a 1 month 2%, almost 2%, 1.92. then for 1 year, 3 years, 5 years, and 10 years. As you can see, the returns have been steady and really interesting returns. So his mandate to select growth companies, he has been successful in doing that. So you could look at the performance. He's definitely doing a good job. The next line, the Russell 1000 growth, that every fund they try to compare the fund to an index. So the index here is the Russell 1000 growth. Obviously, you cannot compare investing in an index with investing in a mutual fund. In a mutual fund, you have much less risk and much less volatility, because an index, if you look at the performance, for example, you could see that it's pretty similar with the performance he was able to bring to this fund. However, keep in mind that if you were holding the Russell, the swings up and down are much higher, and the risk is much higher. And why? Because there is no selection there. It's just a bunch of stocks that are there because they are part of the index. That's it. So you don't. So if you stock one day and you want to sell, you're really like, if you're selling in a down market, you'd rather hold a mutual fund than hold an index, because an index will fall much quicker, much faster, versus a professionally managed mutual fund. This is assuming the manager is obviously a good manager. Then they compare the return to the category, and you could see that he's exceeding his category. Then you have the kind of ranking. But what I want you to focus on is really the performance, if it makes sense to you and if you're interested in it. Then you have the fund size. I really like to look at the fund size. You could see that this fund has almost $10 billion under management. So there are a ton of investors there that are trusting this manager, and 10 billion is a lot of money. So for sure, that's an indication how successful this manager is. Is he able to get a lot of investors to buy the units in his mutual fund? Also, then you look at the MER. Well, with the MER, if you look at the Morningstar, for example, for this mutual fund, they're saying is a 5 star. How they give a 5 star is they look at the performance, but also look at the MER. If it's too expensive, the Morningstar will not provide a 5 star ranking for a TD blue chip equity fund. So yes, you have to look at the management expense ratio. And yes, 2.38% is high. However, Morningstar has already done the comparison for you for equivalent for funds that are doing the same. They are in the same field, the same management style, and they're saying it's a 5 star. That means he's charging what his competition is charging. And then you have the minimum investments. Obviously, a lot of funds there. Before you can buy them, you have to look at the minimum investments, because some of them are 25K, 10K. So in this case, this is open for all investors, and it's $100. I'd go back again to the asset under management. If you have a fund that asset under management is under 100 million, do not buy, because you will find yourself in you have two problems with I have two problems with this. First, the liquidity. If a manager is managing a $100 million fund, there is an issue with liquidity. And the second one, the $100 million fund, he will not have a lot of option in terms of investing and a lot of stocks or holdings. Plus, it will cost him more fees to invest than someone who has 10 billion. 10 billion, he has much more flexibility, and he would be paying less, obviously, commissions and all that. The last factor that I want you to look at is the turnover. It's really key to look at that percentage. You will be surprised. You look at a fund, everything looks good. They've been doing great, but then you look at the turnover and you're like 100%, 70%. In this case, it's a very respectable turnover. It's only 28%. What a turnover means is that this manager, how think of it of how many times he's changing his mind in terms of stock selection during the year. How much he's buying and selling of stocks. Let's say he bought a stock and he figured, oh, it's not a good stock. Then he has to sell it, then buy another one. That's with turnover. So when they're providing you with the turnover, they're telling you, okay, listen, this guy has purchased some stocks during first of the year thinking they're going to do well. Then he changed his mind and he changed 28% of his portfolio, which is absolutely okay for a fund this large. For example, if you see 70, 80%, that means he had picked a lot of stocks and then he figured they're not a good choice and he had to sell them and buy other ones. And usually, what happens is that they will buy, they know that they picked some loser stocks. So they try to sell them and buy stocks that everyone knows that they were during the year a winner. So just to show, so they show in their holdings that they've been picking the good stocks. But in reality, they have not. So if the turnover is low, that means they are confident about their stock selection. If the turnover is really high, that means they're changing their mind during the year, selling and buying because they lost some opportunities or they're not happy with the stocks that they bought at the beginning of the year. So you want someone who once he picks a stock, he stays with it and he knows it's a good one, instead of a manager who's basically trying some investment strategies and you don't want to pay an MER of 2.38% if a person is changing his mind during the year. My advice in terms of mutual funds that you should avoid, like if you look at the TD blue chip fund, he has chosen to invest in technology. But let's say technology is not doing well, he could go to, I don't know, oil and gas or consumer staple. So he has the latitude. Why? Because the fund objective says he can pick any stock as long as it's a blue chip stock. So his only condition is blue chip. When you buy a mutual fund that right off the bat it's saying this is an oil and gas fund, that means he has to invest only in oil and gas. He cannot invest in any other sector, even if he knows that oil and gas during a specific that year is going to do bad. He still has to keep investing in oil and gas because that's his mandate. You purchase his unit with the condition that he follows the fund mandates, and the fund mandate says invest in oil and gas. So when you want to buy a fund that's open, let's say a growth fund, so he can invest in any stock that he thinks will bring growth instead of just limiting himself to one sector on one area or just small companies or big companies. So try to pick mutual funds that are kind of open. Also, if you notice high returns but you have high volatility comes with it, no. If you high returns and high turnover, as we spoke about the turnover, no, try to avoid that. High return and high volatility would be like a good fund which has a very pretty high returns, but when you look at the Morningstar criteria, he will find that his risk taking is above average and his return is above average. So he's taking on more risk to exceed the average return for the category. You don't want that. You want people who minimize the risk and exceed the return for the same risk. And also, you have to avoid, as I said, mutual funds that have only short existence and also like low asset under management, let's say less than 100 million. You definitely want to stay away from those. And the best advice can a financial advisor give you is you are in it in the long haul. Don't try to anticipate the market or pick value stocks, growth stocks, uh, that you've done an analysis, a mutual fund that you know has been a good manager, been there for so long, and stay with your choice because the markets overall will bring you the return that you're expecting, obviously, but the return will be relative to the risk you're willing to take. So Most investors are risk averse. It's preferable to select a bunch of mutual funds with good managers there, and forget about it for a couple of years. That's the best strategy than trying to follow the trends, buy and sell. That's never a good strategy for in terms of investments. Obviously, it makes money for banks to buy and sell, but for you personally, you'd rather you have other things to do in your life. You'd rather pick good funds, good performance. You've done your job. You looked at the manager. You looked at his track record. You looked at the risk that he's taking, the returns that he brought. And once you're comfortable, you buy your mutual fund and you forget about it. And don't be greedy. Stay diversified. Let's say you invest in three or five or six sectors. Your strategy is going well, but some sectors are doing much better than others, and you decide to sell all the other mutual funds and keep just a mutual fund in the sector where it's been outperforming. Never do that, because diversifying is your best protection. It's like an insurance. So if you decide to cancel your insurance, is at your own risk. And as you know, the stock market is never stays the same. So it's better to be diversified and have some losses in certain sectors or certain mutual funds and gaining in others, and on an average being at a very decent return. It's better than being put all your eggs in one bag, and just take the risk, because the more risk you take, the more chances you're going to lose your investment. This is the end of my video, so I wish you good luck and thank you for watching, and please don't forget to subscribe. I will be adding more videos looking at the ETF, the Exchanges Traded Fund, and comparing them also with the mutual funds. Hope this video helped. Thank you.